Welcome back to Financial Independence 101. This is Mike. Today I want to talk to you about the Federal Reserve's decision to cut rates by 0.5%, what it means, and everybody was expecting 0.25% for the most part, and I pretty much thought it was almost carved in stone, 0.25% for the next three meetings, and they went 0.5%, which is basically admitting that things are way, way worse than they were trying to say, than everybody's saying. But I already knew this. We all knew this. We're going to get into how this affects everybody that's pretty much invested, not invested. You're working, you're paying for stuff, inflation. How's this going to affect you? How's this going to affect your interest rates? How's it going to affect all that kind of stuff? I'm going to discuss all of this, but we're really going to talk about how this is an indicator that things are really bad, and I'm going to show you very specifically what I'm talking about coming up. All right, so the Federal Reserve slashed interest rates aggressively Wednesday, announcing the first rate cut since March of 2020. The reason that this is the first rate cut since March of 2020 is because they've had basically a low interest rate policy. Now, the nominal rate, if you look over the past probably 50 years, 4.5% is the nominal rate, the normal rate. But now it's being skewed because we've had artificially low interest rates hovering around zero for over a decade since the Great Recession of '08. And when you look at this, they tried to raise rates and then they couldn't because of all these problems that I'm going to talk about. Then they took them back down, and so it's a band-aid. Well, now once they raised them again, they couldn't keep them up there for all the reasons I'm going to talk about, but it's even worse. They did cite the unemployment, which we will talk about, but 4.4% is an expected increase of unemployment. And with that, they're trying to say that they've cooled off the economy too much. They've won against inflation too hard. Now they have to lower interest rates, which is the complete opposite of what's really going on. All right, I'm only going to clip what we need, and these are nice, fun snapshots in time. 35.3, almost $35.4 trillion. It's only been like a month or 6 weeks since we hit 35 trillion, and we're already a third of the way to 36 trillion. So we'll be 2/3 of the way there by the end of the year easily, and almost we might even hit the 36 trillion by the end of the year. The thing is this is the number one reason they're cutting. I don't care about the fluff and what they're saying. And Jerome Powell, although I think he's doing a pretty good job, he's done a better job than the last two Federal Reserve Chair people, but he still isn't 100% honest. He is honest about a few things, but this is the biggest problem. We've lapped the $1 trillion in interest that we're paying, and then by the end of the year they expect it to be 1.4 because of all of the debt that is rolling over, meaning it expires. They got to put out new debt at the new higher 5% rate, and then by the end of next year it'll be 1.7. So that's kind of what they're looking at, that they're not going to, it's just a terrible waste of money, right? But the interest rates, they affect so many things, and the $1 trillion a year they're spending on the interest is the number one reason. So they're saying inflation is getting closer to the 2% mark. Now, you also have to look at the fact that this is inflation on top of, in some cases, there are certain items that are already 300% inflated, meaning they are triple the price of what they were in 2020. So you got to think of the last few years, the rampant inflation, and they're saying now we've got it down. It's still 2.4% over the 300% it's up. So that's not a good number. 2.5%. I really don't like the idea that they have a target of 2%. I'm okay with a 20% down. Now that would be terrible and devastating to governments because they can't inflate their way out of bad spending and irresponsible spending. But inflation should be zero. That should be the target. I believe that. Anyway, they're going to say they're going to get it down to the 2%, but lowering this is going to cause massive inflation in the future. And the fact that they're doing it pretty aggressively, well, I'll tell you why they didn't do 0.75% is because that would be alarming to the markets and alarming to everybody else. At a 0.75 would be actually telling everybody that the wheels have fallen off. So they're doing 0.5% and open to a couple more in the future. But they're saying that they hit the target, or they're closer to the target 2%. And we're going to see inflation creeping back up here at least within the next 6 to 18 months. By the way, the inflation numbers are cooked. The books are cooked on the inflation numbers. They don't even look at the same as they used to. I mean, it's really, if they're admitting to 2.5%, you know it's 6 or 7%. But 186 banks in danger of failing. I've seen stats up to over 1,000 banks possibly to fail. Now, this is an older one, but still, even though this article's a little old, it's still talking about a problem of banks in the danger of failing. And the reason banks are in danger of failing is because banks do stuff with the money you deposit. They don't just hold it in a vault. There's some in a vault, but not the vast majority of it. Like 90% of it is loaned out, or something's done with it. It's not all loaned out. Some of it is invested into higher yield savings and stuff like that. But when a high yield is 1.1% and they're investing for 10 years on it, or 8 years or something along those lines, and then rates go up as sharp as they did, then they need money and capital to pay out people that are trying to make their withdrawals, and they're selling it at a discount, 30, 40% less, because rates are up and their old 1.1 is down because 5% rate instruments are available now. So that this is a problem. So fixing or making it easier, easing on the banking system is another major reason why they're lowering the interest rates, because the sharp increase in interest rates was hard on the banking system. Decreasing interest rates is going to be easier on them for that reason, so they're not losing money every time they sell a financial instrument. We're getting back to this jobs thing here. So they're admitting that they expect to see a rise in unemployment. And the 4.4%, again, that number is looked at differently now than it used to be. There's a couple of reasons why they look at the jobs number different now. The number one reason is the fact that they don't count people that should be in the workforce, that are choosing not to look for a job. Maybe they're discouraged, they didn't find a job, or something along those lines. So they don't count those people. They're just counted out. And if you counted on them, we would look like Depression era unemployment anyway. But then the other reason that it looks lower, it looks low because they count people that work Uber, like 5 different jobs, as 5 employed people. So it's really hard to even make any sense out of these numbers that come out these days. But just sticking with this, they can make it look however they want. Now, there's a couple of ends of the coin here with this 818,000 fewer jobs than reported. They adjust these down, and they've been doing this for a while. So after about 3 months, then the old number gets adjusted down by 60,000 jobs. 60,000 jobs in a month. And people are worried about the new number, the new hot. What's the September number going to look like? September's looking at August. So what's the August number looking like? And who cares about April? Well, I care about April. They lied to us in April. And so here we are, almost 1 million fewer jobs than reported. And that's just a huge glaring red flag that we have economic problems in the U.S. And by the way, all the problems we have in the U.S., most other countries have the exact same problems. Some to a lesser degree and some to a higher degree. So now what's really important is, what does all this interest rate decrease mean to you? How's it going to affect you? How's it going to affect the average person? And today, tomorrow, by the end of the month, probably even by the end of the year, nothing, really. It's not going to affect the average person very much at all. It actually affected me. It affected me before they even lowered the rates. So my investments went up through the roof, but my other investments are going to lose the interest rate. So I'm going to make less on some investments. So that's kind of like how it worked for me. I'm mostly in fixed income anyway, so it's highly volatile right now. You usually don't see fixed income portfolios swing like mine have, but it's because of the fact that these interest rates are changing, and it's going to swing even more once they actually fully go into effect. But the average person won't see much. Let's get into a little bit more detail on that. I guess I should have led with I'm mostly a fixed income investor. I like betting on a sure thing. I feel like I'm in Vegas betting on a sure thing, but See, so they're talking about the challenge is that soft landings are rare, and as much as luck as skill, about luck as skill, they're basically saying that whoever expects the Fed policy rate to be at 4.25 to 4.5 by the end of the year, we have never achieved a what they call a soft landing before. They've never been able to achieve that. The thing is that when you have such high inflation and you take such drastic action, which I really don't feel like 5% is drastic action. I feel like the speed at which they went from near zero rates to 5% was the drastic action. The one thing I will say about Greenspan is he took his sweet merry time to go from 1% to 5%. It took forever, but Jerome Powell did it fast. And that's what hurt the banks. That's what hurt a lot of people because they did it so fast. And so with that, there's nothing wrong with the 4.5%, 5%. There's nothing wrong with the 5% rate because that's about normal. It was the speed at which he did it, which was the bigger problem. There's also, it goes into talking about we're going to see lower mortgage rates. But guess what? If you already got a fixed mortgage, your mortgage isn't going to go down. And if a 0.5% is not worth it to refinance. So most people won't be affected with their house payment. Your credit card's interest, it will slowly lower if you've been making all your payments, do everything on time and having good credit. But if you have bad credit, it probably won't help you at all. So there's a lot of things in here that's just really not going to be affected. The average person is not going to be affected by this. And if they are, it's just a small amount. And it will affect people if you're looking to buy a house. You can get it a little bit cheaper. But the reality of that is there's a whole song and dance when you're buying a house because the seller might not come down as much on the price. So the offers might not be accepted even though you're getting a better deal on your interest rate. And this will actually punish savers. It'll hurt savers. And the thing is that if you have money in the bank and you've been getting that 5%, now you're going to be getting less and less. Kind of like I explained about myself here, but if you are in this situation, I like how this is worded. People who've enjoyed collecting steady, near riskless money from a multi-decade high interest rate will likely see an almost immediate decline in savings and CD yields, experts say. And that's true. It's your saver, and you're getting the 5.15% in your money market, or if you're just what you're deposited in your bank in an FDIC insured bank, and you're getting maybe 4%, that'll drop to like 3.8, and so you'll start seeing less and less and less. Now that's going to go gradually down over time, and then eventually get down to that 0.1 again. So now is the time to act. In my opinion, for me, I'm looking at locking in a CD rate, something that's going to be like a 5% CD for a little while, maybe 5 years or something, just to see what's going on there. But that's an option, things to look at before the rates start plummeting. And we know that they're planning to go down, but they also left it on the table that they go back up if they start seeing a spike in inflation. But I doubt they'll do that. I doubt they'll reverse course now that they're heading straight down with interest rates. So it'll be interesting to see how this affects our GDP, if this actually is going to improve our GDP or not. And of course, I believe, because the numbers support it, that we are in a depression, and we've been in there for 2 years, but then they've used some fancy numbers to make it look good, to put lipstick on a pig. They're holding it together until the election, and then the wheels can just fall off, and it will be quite interesting and devastating to watch. But anyway, what do you guys think about this? Do you feel like you're going to be impacted by the interest rates? And if so, how do you feel like you're going to be impacted? But I really don't feel like the average person will see much of a change other than less interest in their bank account. But like and subscribe. Financial Independence out.